The views and opinions expressed on this program are not necessarily those of this station, JVC Broadcasting Management, or its sponsors.
With so many people living longer, the fear of outliving your money becomes a reality for many of us. Will I be a financial burden? Will I outlive my money? How will I be remembered? My name is Neil Himmelstein, president of Main Street Planning Group. Please contact me by visiting mainstreetplanninggroup.com. That's mainstreetplanninggroup.com, or call 631-647-4694. I will introduce you to strategies that will guarantee you will not outlive your money, that can guarantee you will not be a burden on your loved ones. Through a collaborative approach, we will uncover solutions that offer tax-efficient strategies, lifetime income, and legacy planning, choice, organization, direction, and education. That is the code we stand behind. Contact mainstreetplanninggroup.com, that's mainstreetplanninggroup.com, or call 631-647-4694. And listen to me every Friday at 3 p.m. as I host the Main Street Code for Financial Success, right here on 103.9 LI News Radio. Good afternoon. Welcome to the Main Street Code for Financial Success. I'm your host, Neil Himmelstein. I'm here every Friday at 3 o'clock. When we talk about our code, we talk about choice, organization, direction, and education. And we like to bring Wall Street to Main Street. Really, we like to talk about Main Street, not Wall Street. And when we talk about our code, we talk about choice, organization, direction, and education. We help hundreds of clients and advisors across the United States with all areas of life insurance, disability, long-term care, annuities, life settlements. So these are the areas we specialize in. We are wholesalers for 30 different companies. We're completely independent. If you want to reach out to me, I'm happy to sit with you, no charge, and go over your situation and how we can help you. One of the things that we do, maybe a little different than others, is we really believe in a collaborative way of helping you with your financial planning. We need to help work with your attorneys and accountants. And I'm involved in a couple of very, very large situations where I've come to the realization of my value prop, and that is, quite frankly, most people, most insurance agents may know their products very well, but they're not real versed in taxation or estate planning or some of the others. I'm saying most. And a lot of these things change, and you really have to keep up with it. But when they're busy just focusing on the insurance, they may not know about all of the changes that are going on. Everything changes, and we talk about this quite a bit. Listen, insurance companies have changed. Many of them are not operating in New York anymore. Many of them are not operating anymore. Products change. Our health changes. Our beneficiaries change. Our situations change. Everything changes. So if you're not keeping up to date or reviewing what you have or knowing about these changes, you could put yourself in harm's way in purchasing one of the most important assets you can have, which is life insurance protection. Now, you may think that life insurance is a commodity. Oh, I'll buy it. No, but it's really a lot more than that. It's probably the number one asset that people use that has a tax-free death benefit, unlike other assets out there. And I'm not talking about just everyday people. I'm talking about high net worth, very wealthy people buy a lot of insurance. And why? Because they understand the leveraging effect of spending $1 and getting 100. The very wealthy buy very large life insurance policies and has tremendous tax protection where it can grow tax deferred, you can take it out tax free, and the death benefit, if it's structured properly, can be estate tax free to your beneficiaries, which is all wonderful things, living benefits, death benefits. So I want to review a situation I'm working with some agents up in, not in New York. and they have this company. These clients they have this big company, and they've maxed out on all their 401ks and pension money, and they want to put additional money into tax-free retirement. So they want the company to purchase life insurance on all of them, put in significant sums, 7 figures a year per person. Significant funds. Okay, and the agents, very seasoned agents, come to me and say, do you have corporate-owned life insurance? It's called COLI. There's a lot of acronyms in my business. I try not to put them on the air because it's hard to keep up with these acronyms. I don't want to be overly complicated. Well, what they didn't realize, and the tax advisor that's part of it didn't realize, is that 3 years ago there was a change in the law. And the change in the law said, it was called Connelly versus Treasury, very important decision that went all the way up to the Supreme Court, that says if I have the corporation own these policies, then that's part of, makes the value of that corporation not bigger by what they put in, but by the death benefit if one of the partners dies. Now, what happened in this decision was that became all estate taxable and increased the amount of taxes that the beneficiaries had to pay when someone died. And it also increased the shares of the company. Now, this situation had 3 brothers. So all of a sudden, all the shares got mixed up, and this became a legal battle, because now instead of the value of the company, let's say, was worth X, now it's worth Y. So the beneficiaries owned a bigger portion of that. And where's that money coming from? Because the life insurance policy only paid a part of it, because now it's double. So the family was looking to get double that amount because now their shares are bigger. And that was to pay for their share of the insurance company. So in the planning, these people came to me and I said, you can't do it that way anymore. And their attorney and accountant and maybe didn't realize that. They have to individually own it or own it inside a trust, and we could talk about ownership all day long. But this is so important. Is this going to be taxable to them or tax-free to them? Are they going to be able to take out tax-free money or not tax-free money? So I have a solution for this. It's complicated. It's called corporate split dollar. But the point of the matter is, if you have a business, any size business, and you put together what we call a buy-sell agreement or a business will, and you're funding it with life insurance, your company cannot own that policy anymore. You have to restructure it. So if you're sitting there, I don't care if you're sitting there with 2-term policies or permanent policies, and you haven't reviewed this, nobody's really bringing it to your attention. You need to call us, because you need to restructure that so that you don't have this taxation. There's a classic example how a tax law has changed in the last couple years, and yet you're sitting on your policies the way you had them, where your company bought them, small, big, it doesn't make a difference, and they own them, and it could create a big tax situation to you. So this is very important to understand. Now we had other situations. We had another very wealthy person come to us, an attorney, who had bought very large policies in the past, okay, whole life policies. When he set up a life insurance trust. Now, why do you set up a life insurance trust? Well, if you set up a life insurance trust and you do it properly and they own the policy, that's out of your estate, so it doesn't become taxable to you. And I can talk a lot more on estate taxes, and we can have tax attorneys come on and talk about it. And people think that since the federal tax rate is so high, there's 2 taxes. There's a New York state tax as well, so you have to keep your eye on that. And the biggest thing that people don't understand, wealthy, whatever, if you're in that kind of situation, is New York state tax is X. It's like 3 to 16% on your assets, and federal is different. Okay, it's a lot more, but the thresholds are different. So federal may be $13 million a person. New York state is $6.5 million per person. Okay, Now, the way New York State calculates the estate tax is very interesting. If it's at $6.5 million and you have $7 million, they will tax the entire $7 million, not the difference. It's a big deal. It's not that extent. They're going to tax that entire piece. This is why you need to understand these kind of things and collaborate with great people that are going to make your plans perfect so that they don't go awry. Because after you pass or you really need the money, that's when they go awry. So we'd like to prepare you for that. You're listening to the Main Street Code for Financial Success. I'm your host, Neil Himmelstein. Best way to reach me is 631-647-4694. That's 631-647-4694. I welcome your questions and comments. Thank you. Welcome back to the Main Street Code for Financial Success. I'm your host, Neil Himmelstein. Best way to get a hold of me, 631-647-4694. And we were talking about lots of stuff. We like to work collaboratively with other professionals to help you in your plans. Believe me, I have a lot of appointments coming up. A lot of people have been calling and making appointments and seeing me. Please give me some time. I want to give you the time that you deserve and need. And again, I don't charge for appointments. This is what we do. Anyhow, we were talking before the break about some very high-end stuff we've been getting involved in. We talked about corporate ownership and how that could be a problem. We have another case, another situation that came to us with a lawyer who had one time bought, I think it was like $10 million of insurance with 4 or 5 different policies with a top-rated whole life company. Top-rated. I mean, in the 100% though. There's 3 of them out there. The salesman left that company and went to another company. And he moved all those policies into his new company. Same type of product. Exact product, almost. Very little different. Just company A to company B. That's not good. That's churning. Okay, it's a bad thing. Okay, he had done the right thing up front. The gentleman set up a trust. The trust owned the policies. Okay, I think when he did the transfer, it still owned the policies. And then a year or 2 later, he bumped into a friend of his and said, well, let's finance a policy, give you free insurance, do something. And he moved him to a different type of policy, to a different company. And now he shifted the ownership from his trust to his LLC. Now, the minute the LLC owned the policies, he's now brought all that $10 million back into his estate. So from $10 million that was out of his estate, we now have a $20 million swing because now it's back in his estate. So what happened to the policies that are owned by the trust? Well, they're gone. He got rid of them. He sold them. He did what he did, transferred the money. So now not only did he lose money, every time you transfer from company A to company B, especially in the early years, you lose money. You as the purchaser have lost money because there's surrender charges, especially in the early years. So these people did not do right. Now, I tell people about this, and they go, well, where was the attorney that did the trust work? Well, guess what? The attorney did the trust work. He's not necessarily in the loop that the policy was put in the trust or that the policies got transferred. Unless he's a trustee on the trust, then he has to know. But he's not necessarily. Usually the attorney is not the trustee on the trust. So who told him that? So, I hate to go back and say who's liable for all this, but you had insurance people that A, didn't understand estate planning because they didn't understand ownership and the difference it makes to somebody. And B, you had 2 different agents that were churning and doing something really bad. And this client is worth $100 million. He's not looking at the nitty-gritty details, and now we're playing cleanup. But my whole point to this is if you don't keep up with this stuff, and I wouldn't expect you to, most insurance agents don't. They're worried about their product, getting their thing, making that sale. That's where they make their money. They make commission. I make commission when I make a sale. Okay? But it has to be done the right way to help you achieve your goals. And you have to know, and listen, I don't know every tax code. I'm not an accountant. I don't know every legal term, but I know enough that if I have a question, I'm going to ask it and bring in the appropriate people to make sure that everything is airtight. Now, everything could be airtight today, and tomorrow everything could change. You got to review what you have, because every year things are changing. Every day things are changing. But in the insurance world, the industry is changing. Like every industry is changing. So tax laws change. How much the estate tax is. Everybody's thinking, well, I'm not in that bracket where I'm going to pay estate taxes. But the next government that comes in is looking at this big debt and saying, where can we get our money? And then it will change. And it always does. Right now, it's at a very high level. If you're wealthy today, you're doing great. If you're just middle class, you're starting to feel some pain. It's those who have a lot of real estate in certain industries, they're just flying high. The market's flying high, but that's only a few people. You got to be very careful on how you gauge the market. And the market changes, tax laws change, and they change, and you have to be aware of them. And as you move forward, they change. And I'm going to tell you something else that we see happen all the time. People get married. People get divorced. People have children. People die. People become disabled. All these things can affect your policies. Now, beneficiaries are very important. And we're going to be talking on the senior show more about that beneficiary thing, because beneficiaries are very important. Life insurance, your 401ks, even your house, even your bank accounts have a beneficiary. If you have a change of life, divorce, spouse died, something else, you need to check all the beneficiaries of all your accounts. Because if you don't, it's not going to go where you want it to go. It could go to taxes. It could go to an ex-spouse. It could go to an ex-business partner. It could, your beneficiary could be an estate. An estate's not established. We see everything. Attorneys reach out to us all the time. Neil, can you help me fix this with this insurance policy? It's funny how people come to me after the fact. So you need to check your beneficiaries. Hey, Tim, how are you? Tim is coming in at the end of the show.
Excellent. Good morning. How are you?
Tim Kennedy,
actually, I apologize. What's happening?
That's okay. Tim Kennedy is my co-host for the senior show. He just stopped in to say hi.
I stopped in to say and remind you that we have a great guest on Monday, Ron Fatula, Elder Lord estate planning attorney.
Fantastic. Well, I want to talk to him about a lot of things, about some of the things I'm talking about right now.
I'm really looking forward to it. I think it's going to be a great show. He's a great speaker, and man, he's good at what he does.
That's excellent. So we're talking about that now because we're talking about ownership of your life insurance policy and how trusts and everything else can affect the ownership and where the money goes. And you have to change all that and be adjusted. I wanted to talk to you about this woman I met years ago. I know I'm running out of time, but this salesperson I had that worked through me sold her a really nice long-term care policy and said, she wants to get a mortgage. And I go to her house. This is in Bayshore. I'll never forget this. And she said, I go, what do you need a mortgage for? House is paid off, everything else. She said she had a tenant upstairs and a tree had fallen through on her house. Lucky the tenant didn't get hurt. It wasn't there at the time. But she didn't have any homeowner insurance.
Is that mind-boggling, or is it just me? A free and clear home in Bayshore, close to the water,
Yeah, near the water.
Yeah.
Didn't even have homeowners insurance. And now she wants to get a mortgage and get money out of her house.
Yeah.
So, I mean, we got to talk about that.
People do that all the time. They free and clear homes. It's the biggest asset they possibly have, and no homeowners insurance. It's really mind-boggling.
And now she's looking for money to fix a hole that she already has.
Yeah, it's crazy.
And this is what people do in life insurance and long-term care. They know, I know I'm going to a nursing home. I want to buy long-term care. That's the best time to buy it, right? Great. Anyhow, you've been listening to the Main Street Code for Financial Success. I'm your host, Neil Himmelstein. Best way to reach me is 631-647-4694. We're running out of time. Tim Kennedy's with Movement Mortgage. He's my co-host of the Senior Show, and you'll be listening to that Monday. And thank you, and have a great day.
See you Monday, Neil.
You bet.
The views and opinions expressed on this program are not necessarily those of this station, JVC Broadcasting Management, or its sponsors.